breath for U.S. jobs data. It's only right. It's the first Friday of the month directly in front of us, and this is when the markets get the official report that so much of their thinking about the U.S. economy and that, of course, Fed monetary policy is going to hinge. So, as we consider what is going on here, we, of course, have to take a look at what is expected of the data, and then how it might actually drive markets as we go. So, what we'll do here is break down that here on Macro Money. As ever, I'm Ilya Spivak, head of Global Macro here at tastylive, and then hopefully arrive at some sort of a trade implication at the end of our analysis, because indeed it looks like something of a change is developing in markets, and we're going to try to put our finger on what that is and how this data may well alter what this data does for stocks, for bonds, for currencies. Let's begin here with a grounding in expectations. So 170,000 jobs expected to appear for the month of January. That would be a little bit of down step from the 256,000 in the prior month, but certainly not catastrophically so. We can see the overall setup here is still well within recent ranges. As we take a look at what the labor market has done over recent months, I think we can quite clearly see we've sort of anchored into a range going all the way back to the beginning of last year, where U.S. job creation really hasn't made a meaningful break one way or another. We kind of cooled from the middle of 2021 into this range and have been sort of oscillating without much movement. A similar story expected from the unemployment rate. The monthly reading from last go round at 4.1% expected to hold steady here. And indeed, if we look at the way that U.S. economic data has tended to perform recently compared with expectations, the argument seems to be toward a slight positive bias on this Citigroup Economic Surprise Index that measures outcomes not in absolute terms, but relative to forecasts and scales them to the volatility that the releases generate when they come out. What we find is 0 is neutral. So this is where expectations and realized results match. We're a little bit above that, so the tendency is gently toward outperformance, but we're very, very close to 0. And so the overall sort of sense here is a tendency to be within striking distance of expectations, relatively close. And indeed, in so much as the ADP report, the private sector estimate of payrolls, isn't usually a very good indicator for what official figures will show, it does give us a preliminary view that suggests relative stability. The number earlier this week came out a little bit better than expected, 183,000 private sector jobs created versus 150,000 that the analysts had on their bingo card. But nevertheless, the overall story, very little changed. 30,000 jobs difference for the size of an economy like the U.S., not really a huge amount of deviation. And indeed, the general story here, that of relatively stable job creation all through last year at least, is about what you would expect. In fact, you can see here a very similar story on the official reading, even if the aggregate figures are a little bit different. The same thing comes from the Institute of Supply Management's numbers published earlier this week. We got updates on both service sector performance and manufacturing, and we can see here the service sector in particular showing steady employment growth. These numbers in the logic of PMIs, and this is, of course, just the employment component of that survey. Above 50 is growth. Below 50 is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. The takeaway then here is the service sector, which employs the lion's share of workers in the U.S. and accounts for overwhelmingly most of economic output, something on the order of 75% of the economy is services, and even more of employment, close to 80% of employment is services. So that we have stability here tells us a story about the overall labor market, and we can see that that has very much offset the weakness that we'd see in manufacturing, where we can see employment has been contracting up until January, where it actually peaked its head above water again for the first time in a while. Not since early last year, late last year, did we see a little bit of a sliver of positive manufacturing sector growth. And it looks like in January we managed to somewhat arrest the preceding weakness, at least a little bit. So all of this seems to point to a relatively stable labor market, and the likelihood that the numbers that we're going to get out of the official figures probably endorses that view continuing. So, what's there to trade here? As ever, the markets operate in a way where it is the deviation of reality from expectations that drives volatility. That's what actually motivates investors to go and change allocations, to trade this or that differently than they had exposure to it before, when they realize that reality isn't what they thought and they have to go rebalance portfolios accordingly. This seems to say that the labor market is going to be relatively steady. And indeed, to the extent that this data, and really any U.S. economic data, is an input into the Fed policy calculus, that policy calculus has been relatively steady. Consider all of the fireworks we'd see episodically, just even over recent weeks, around the unveiling of DeepSeek's AI model from China that purports to rival U.S. offerings, but at a much lower cost to train comparable models. Consider the here today, gone tomorrow U.S. tariffs saga at the start of this week, where the Trump administration moved to levy tariffs against Canada, Mexico, and China, and within 24 hours, only the Chinese tariffs were left. So the share of macro volatility here and just episodic out of left field event risk has been, let us say, not negligible. But nevertheless, we can see here from Fed policy expectations, we've not gone very far. Markets now baking in 44 basis points in rate cuts for this year. That's almost exactly in line with the Fed's own prognostication from December, 50 basis points expected there. And really the divergences for next year. Markets are at 21 basis points, so not even quite at one cut, although that one cut is pretty close to being baked in, just 4 basis points off. But the Fed had 50. So this is where there is a little bit more of a departure. In cumulative stimulus between this year and next, the markets are at 64 basis points and the Fed is at 100. So there is a non-negligible difference there in sum of close to 2 rate cuts. So perhaps the state of steady numbers here is coming at a time when the expectations for this year are relatively anchored. They've been so impervious to event risk that the markets don't seem to be of a mind to speculate there. And maybe that then puts the spotlight on next year. Because, again, if we take a look at near-term policy expectations, we can see not only have they been remarkably steady recently, they've been remarkably steady since November. This was the Fed's big dovish outing in September here, and we can see by November, as the markets start to reprice expectations to say the Fed's more dovish inclinations don't make much sense when you consider that the U.S. economy by then is heating up after a few months of slowing. Moreover, you have the election pass, and it passes with obviously a victory for President Trump, whose economic platform is thought to be generally inflationary, be it tax cuts and deregulation that ostensibly boost growth and thereby drive up inflation. Growth and inflation tend to walk hand in hand. But also the possibility of tariffs and of some sort of a labor market disrupting deportation campaign of migrants that would purport higher taxes on imported goods. That's inflation. And likewise, a higher cost of labor. That, of course, is a more expensive input into almost everything, and so higher end prices. With that, it stops to make sense that the Fed was quite as dovish as they were in September, and by November already, the markets have made the switch. We can see here that thereafter, the subsequent meeting in December where the Fed makes the switch official, endorses it with their own forecasts, that's already barely moved from where we were already by November. And indeed, the most recent numbers here, following a Fed policy announcement just earlier this month, almost unchanged. Very steady here still. So already as of November, near-term Fed policy expectations, at least as far as the markets were concerned, seemed fairly well established. Stock markets have seemingly echoed as much. Note that for all of the gapping and the shenanigans with DeepSeek and the tariffs and this and that, what we've found is that since early December, the bellwether S&P 500 has gone basically nowhere. It's been stuck in essentially a 6% range. And while we've seen these sell-offs, this is the DeepSeek sell-off, this is the tariff sell-off earlier this week, while these gaps have closed, or at least tried to close, we've also not exactly shrugged off the bad news, else we'd be rallying. We'd be breaking these highs. But the market still seems somewhat circumspect here. It's not convinced, apparently, because we are still stuck in this range. And maybe the stasis of policy expectations, at least at the near term, has something to say about that. But where interest rates would likely be even more front of mind, that's interestingly on the move. And it's at the long end of the curve. That this is the continuous contract for the 30-year long bond. And what we see here is a significant rebound. And if we were to look at the benchmark 10-year, it's much the same story. Now, in line with relatively steady Fed policy expectations, the 2-year, so the front end of the curve, very steady, not really going very far at all. But interest rates are absolutely on the move at the longer end maturities, and more interestingly still, they are now at the lowest level in 8 weeks. Yields, of course, move inversely of bonds. So when we see this bond rally hit an 8-week high, the flip side of that is an 8-week low on longer end yields. Moreover, the bulk of this move has happened on just 2 days. This one, that's January the 15th, and this one, that's yesterday. This right here is that DeepSeek news that gives us a bit of a pop that we then stop to digest. But it's really this move here and this one that do the heavy lifting. And tellingly, those are both economic data days. The first, the US CPI report, that gives us slightly lower core inflation than expected. We can see here the headline comes in line with expectations, and that's to be expected as we get easing influence on energy as the rebasing of these energy contributions becomes less negative. We can see core inflation comes up, or headline inflation, comes up a little bit. Core here has been steady, reflecting the conditions of the core services contribution here, which itself has been fairly steady and which has been, of course, the focal point for the Fed. But the aggregate numbers are a little bit softer, 3.2 versus 3.3% expected. So that's one jump in bonds and one lurch lower in yields. And the second come just yesterday with disappointing US PMI data that showed us the slowest US economic growth in 12 months. Worryingly, that came not as you saw a little bit of a perking up in manufacturing, again, coming out of contraction territory and actually giving us a positive result at 51.2, but a slowdown in the service sector, which had been, of course, the main engine powering this strength all of last year. Moreover, even though employment was relatively steady in the parallel ISM PMI numbers, the actual headlines were also weaker in aggregate because of services. Again, a slight beat on manufacturing, but the meat of the economy is services, and here there was a disappointment. Of course, putting this in context by component, yes, indeed, as we saw earlier, employment relatively steady, but the price component as a implied demand gauge lower, and perhaps more worryingly still, new orders significantly lower and approaching standstill. Now, this, of course, is worrying in a much broader sense, because what this implies is that this very state of affairs is starting to show some wear and tear. Now, to see that most inflation here sits in the service sector implies that most of the demand is there, that the abiding driver of the U.S. economy is the service sector. Note, there is virtually nothing comparable on the goods side. That inflation is fractionally negative. So there really is no major growth in goods demand. It seems to all still be in services. And indeed, that's how this slowdown in services gives you the lurch lower in the overall composite. Now, with that, the global aggregate, this is now global PMI, as we can see, looks very much like its US version. Relatively steady from mid last year until we get this lurch lower. And that really speaks to just how sensitive overall global growth is to this single point of failure, the US service sector. And that, of course, is because global growth primarily is made up of just three economies: the US, the Eurozone, and China. That's 58% of global GDP. The remaining 42% are mainly vendors to the former three. Think Canada and Mexico, appropriately enough, for the US, Central and Eastern Europe, Nordic Europe for the Eurozone, commodity producers in Asia, in Latin America, in Africa as well for China. So it's only right that global aggregates start to break down as the U.S. service sector breaks down when we consider that since the middle of last year, it's been the U.S. shouldering all of the burden on growth. These are composite PMIs that we just got updated this week, showing what happened with overall economic activity growth in China and the euro area over the same period. And now in January, we can see for China, it's slowdown. For the euro area, it's slowdown. And they've only just barely managed to return to growth here, only fractionally at or above 50 here. But the U.S., that's where the strength has been. That has been the global economy. And it's this lurch here, most recently, that then powers what we see here. Things are steady, and then down we go. What does all of this mean in aggregate? Well, if the bond market is willing to do this, while Fed policy expectations remain relatively steady, as we see here, then the story really isn't about what we are going to get this year. What that is seems pretty well anchored in place at this point. And that the bond market is doing these things around slightly soft-footed economic data at first and meaningfully soft-footed economic data yesterday next, all that seems to suggest that what is emerging here is more of a cyclical concern, a sign that maybe the U.S. economy is starting to cool finally. And while that may not alter Fed policy expectations immediately, it may very well start to alter the pricing for next year where, as we've just mentioned, the markets are lighter than the Fed. The Fed is at 50 basis points. The markets have only baked in 21. What does all this mean for the jobs report? Well, if the tendency is for this to come out broadly in line with expectations, then the report might be more impactful in its passing than in its substance. If we get a number or a set of numbers that's relatively close to expectations, as we might expect looking at this, then we are looking at a situation that's more of a roadblock overcome than anything that ought to alter the course of sentiment. And then the markets are free to do that which they have been doing, near-term Fed policy expectations notwithstanding. That, of course, is this. So once the numbers pass, it may very well be that bonds just continue to move higher because a roadblock has been pushed out of their way. Moreover, the stasis in stock markets may start to give way on the downside if, in fact, what the markets are starting to position themselves for is cyclical cooling. And of course, whether that breaks the larger range here from early December and finally gives these markets some directional conviction after now almost 2.5 months idling, having broken the uptrend from August, that we'll have to see. And that's macro money for today. We're here Monday through Thursday, right after Overtime, show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go there from. I'm likewise on with Chris for Futures Power Hour Mondays and Fridays. That's tomorrow right after the jobs data. We'll break it down. I am likewise on with Victor Jones for the Price of Truth on Tuesdays. Back with Victor and Tom for First Call on Sundays. Writing for the News and Insights portion of tastylive.com and commenting at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky. If you're watching on YouTube, like and subscribe. Macro Money's back next week. Take care.